focus today on the investment debate is going to be gold. Equity investments have given fairly tepid returns in the recent past, and data now shows that bulk of small savers' money is moving to assets like gold and real estate. In fact, investments in gold ETF or gold exchange traded funds have been rising, while equity funds have seen some outflow or a degrowth in the first quarter of 2012. Bianca Ghosh is joining us now to take us through the big gold run of the last decade and lay out the basics on what's behind the move in gold.
You know, Manisha, ever since we decided to do this discussion and I've been looking up returns from gold in detail, I've been tempted to go in and put in some money into gold myself because the returns are simply fabulous. Sample this. In 2001, the price of gold averaged $273 an ounce on the London Metal Exchange, and since then, the price has increased every single year, averaging more than $1,500 an ounce in the first 6 months of 2011, and it's rising further still. The primary denomination of gold, of course, is dollars, but since we buy gold in rupees, so I'm going to use that measure right now. Over the past decade, gold has risen 400% in rupee terms in India, and annualized returns throughout this one trend that gold is increasingly being considered as a reliable hedge against credit risk, currency risk and inflation. We started off the fiscal year 2007 with gold averaging about 8,400 rupees per 10 grams, but by the end of that year, that's jumped to 9,300 rupees. That's, of course, a more than 10% jump. The returns double in the next 2 years that follow, so over 29% returns from your gold investment annually. So basically, say if you have bought gold at around 9,300 rupees in April of 2007, your investment is likely to go up to 15,000 rupees by April 2009. Returns in FY9 and 10 have been slightly lower, of course, but remember, that's also when the world economy was recovering from the financial crisis, so there was hope, a bit more of positive sentiment, and people's risk appetite was back. But as the financial crisis mutated from a mortgage crisis to a banking crisis and now to a sovereign debt crisis in the largest economies of the world, in India at least, annualized gold prices spiked up 35% in FY11-12. Behind these statistics, there lie a series of interwoven global economic realities which together, they're increasing gold's relevance in today's world. And as the rupee depreciates against the dollar, something that we have seen in the last couple of months, the same amount of gold brings you a lot more. But Manisha, even as supply and demand fundamentals for gold, they continue to be stronger than ever, the respect for gold remains as is, and appreciation for gold's relevance in today's troubled world seems to be just beginning. I want to leave you and our analysts here with 3 questions. 1, can gold continue to make new highs this year? 2, given the current economic and the sovereign crisis, where is the floor for gold prices? And lastly, I want to ask, if gold, having depreciated 4% in the last 4 months, is it time to consider that 10-year bull run is over now? With that, it's over to you.
Bianca, thanks very much. I'm going to ask the analysts all the 3 questions that you've asked, but let me first introduce them to you. We've got Ketan Kothari, Director, Supama Commodities Limited. An expert who does not hold much faith in this investment firm is Kunal Shah, Head of Research Commodities from Nirmal Bang Commodities. Hi Ketan, hi Kunal, thanks very much for joining in. So my colleague has laid out the map of how gold has done, and it's been spectacular in the last 2 years specifically, and decade has been phenomenal. So I'm going to first come to you, Ketan, because you like this investment firm. What happened this week? Is it beginning to look shaky? Do you think that gold had a great run and we should be expecting the same going forward?
See, as far as gold is concerned, obviously there will be a lot of ups and downs in the prices simply because gold is always measured in dollar terms. But you don't really have to look at gold on a week-to-week basis. In the medium run or in the long run, if you go to see, gold is still expected to give decent returns to the investor, maybe not as spectacular as in the last 10 years, but it will still give decent returns simply because the US government, the US Fed Reserve has already announced that they are not going to raise interest rates till at least 2014. Add to that, the economic scenario world over is not looking great. Even in the US, the unemployment rates are really high. The US government might have the same fiasco as it has been last year in terms of their deficits. So the government may face another issues, and then there are elections in the US. So if you consider the international scenario, it's not going to be easy for gold to just have a come down run, and also gold has a very good support in terms of physical demand, not only from India but also countries like China.
In fact, China overtook India this month, I think, wasn't it? Some data recently which I read in terms of importing gold or consuming gold. That's an interesting data. But Kunal, what's your counterpoint? Gold is, Ketan of course firmly believes that don't look at the weekly prices, don't worry too much if it slid this week. Look at the long term and you'll still do well with gold, perhaps not as well as the last decade.
Yes, the very important thing which what happened to gold since last 2 quarters is that it is moving very much as a risky asset class rather than safe asset class. If you see in the last quarter of 2011 where there was a serious credit crunch in Europe, along with all the riskier asset class, gold prices corrected sharply. And when the time when the LTROs was introduced in the month of December and February, we've seen a spurt in gold prices, and again the LTRO effect fading, gold prices are going down. In spite of the fact the economic worries from all the Eurozone countries are accentuating every day, are intensifying every day, and despite of that, gold prices instead of moving up are going down. So you have a very strong economic data coming from US that is seen supporting gold as far as the downside is concerned. In spite of the bad European data, we are not seeing any upside in gold. So in near term, we believe that this pressure is likely to continue on gold futures, and gold futures are going to remain under pressure. The only trigger for me to be bullish on gold is the breakup of Eurozone. In that kind of scenario, gold has power to again shoot up like it did shoot up in 2011, in 2010. So in a worst scenario where you see a breakup of Eurozone, I think that is the only point which can take gold futures to almost $1,900, $2,000. So I think the trigger for gold to move up lies in Europe. If there is a breakup, I think then gold is going to shoot up. But in near term, I think it's going to remain under pressure.
Okay, so you're saying that a lot depends on the international situation, especially in Europe. Ketan, I'm going to come back to you. You mentioned in your answer that, okay, it may not do as well as it has in the last decade, which has been about 18 to 20% plus, but going forward, it will be more muted. So what is this more muted figure? I mean, if I'm building in a financial plan with gold in the portfolio, how much should I build?
Typically, as an Indian investor, if you go to see, all of us invest in gold. There is no one who will tell you that even if the gold prices are going to go down and if I have some savings, I would not invest in gold. Most of us obviously have our bank savings and FDs. We have a huge investment in real estate, but people are not confident about equity markets. So if a small investor wants to invest his money, he'll definitely go in for gold because it also has that additional value of consumption. If I put it in number terms, maybe the gold prices may go to around about 30 to 33,000 by the end of this year or the start of next year. But you don't really have to see the prices in just like for a few months. The main idea here is that even if the prices do go down in gold, there is such a huge physical demand from all the countries in Asia that prices we cannot drastically go down the way it goes down in the equity markets.
Kunal, you said that in the short term you think that gold's actually going to slide a little. Gold futures are looking weak. So where would the support come for gold in terms of gold future prices? And then if you do see the Eurozone unfolding in the scariest of ways, or let's say, you know, what one is imagining, the worst case scenario, then do you think that gold would have the potential to actually run up another 20-25% up?
Well, I'll simplify it further. When you talk about a lot of people have a question mark. I mean, gold futures have rallied for last 11 years. So in next 5 years, 6 years, would it be able to rally in the same way? Would it be able to give the positive returns like it did in last 11 years? The key to this question is that till there is a negative real interest rates sustained in the developed economies, I think till then gold prices are going to remain buoyant. They are not going to correct sharply. But the day this negative real interest rate cycle starts turning, so for example, we have a scenario where Federal Reserve comes up in a mid 2013s eyeing that the economy is improving. So when this cycle starts reversing, gold, if you remember from 1980 to 2000, when the real interest rates were into positive territory, gold had a 20-year bear run. So when you say that gold prices are going to keep moving up, I don't think so. That's the scenario. When you have a real interest rates coming in, the real interest rates starts to become positive. At that time, gold is not going to give you better returns. At that time, the riskier asset class are going to give better returns. But at this time, since there is a massive currency devaluation has taken place in the world since last 3 to 4 years, there has been a massive monetary debasement which is going on, and the real interest rates are negative since last 4 to 5 years. That's the only reason why gold prices are holding up at this level. There were days, there were years where the demand from India and China was not as robust as they were supposed to be in 2007, in 2008. Indian demand was not there, but in spite of that, gold prices moved up. So there are a lot of reasons, and there are a lot of factors which affects the gold prices. But I think the key here is the real interest rate. The day this starts going into positive, I think that time gold prices are going to correct sharply.
Okay, Kunal. So it's great actually. Ketan, Kunal on the opposite sides of the spectrum. Well, viewers will make up their own mind. Thanks very much, gentlemen, for joining us here on this very interesting debate on gold's future. Really, nobody has a crystal ball to make an exact prediction, but well laid out facts and counterpoints do help us take a more rational decision with our money. And just to give you a perspective of what is real interest rates, if your inflation is really high, for example, on a bank deposit, if you're earning about 8%, 9%, but inflation in real terms is about 10%, then you actually have a negative interest rate scenario. Gold is a great hedge against inflation. It will do well in inflationary environments, but as inflation comes down, gold stops performing very well. We'll keep, and thanks so much for joining me today.